Okay, peeps, welcome back. So today we are going to be talking about the Fed FOMC meeting press conference that just happened today. It was scheduled today at 11 a.m. Pacific Standard Time. For those of you who is on the East Coast, that'd be 2 p.m. your time. So they paused rates. What does it mean? Let's get it. So the first thing that we want to bring up is the actual meeting date. As you can see here, it's literally on the Fed's website. September 19th and September 20th is the FOMC meeting. What investors care about is Jerome Powell. He is the United States Federal Reserve chair, basically chairman of the Fed, pretty much is who he is. So he's the top dog. He reported today on the 20th. That's what people that are in the markets care about. You guys can look on YouTube and type in the FOMC meeting for today and take a look at everything yourself. So basically, what the Fed came out and did is they decided unanimously that they were going to pause rates. So why is this important? Well, the Fed rate hiking and cutting cycle works in three sections, okay? They raise rates, then they pause rates, and then they cut rates. The reason they raise rates is because inflation's high. The reason they pause rates is because they feel that they're being sufficiently restrictive in the level at which the rates are raised to basically suppress inflation to bring it back down to their target, which is 2%. And then they cut rates once they feel it's sufficiently at whatever their benchmark is at the time. So we're going to take a look at some metrics today, and then at some point here, we're going to get into what my projections are going to be for what the Fed is going to do, and basically all of the other related indicators that we'll look at. So this is the FOMC meeting calendar. The next meeting takes place at the start of October, November, or end of October, start of November, and December 12th to the 13th. What is the Fed looking at? They're looking at the CPI data, which is one of their many measures of inflation. This is a particularly important one because it talks about all the different potential inflationary measures within the economy, like expensive housing and expensive transportation and gas and food and beverage and stuff like that. Okay. So the next three CPI releases, they usually come about the middle of the month. So we have one next month, one in November, one in December. And you guys can see that the meetings happen basically at the start of November and the middle of December. So the Fed is going to be able to take a look at all three of these data points before the end of the year. Now, if we take a look at the Fed calendar for next year, because it is actually up here on the Fed's website, you guys can see if we scroll all the way down here, you have the 2024 FOMC meetings. So going into next year, we'll have basically, it looks like about 4 meetings before the middle of next year. So here's the FOMC calendar, which is presented by the CME Group. We've talked about CME Group before. So here's the probabilities on the future Fed hike rates. So let's take a quick look at this. So this is the November one. As you guys can see, the probability of a rate hike in November. Again, on the charts, we're showing 5.33%. So we'll go back. That's basically in line with this. So pretty much no rate hike expected for November. You get December. Let's actually go back and take a look at this. So in December, no rate hike, but the probability of a rate hike so basically they're flat. The chance of a rate hike is reduced. If we go to next year, again, no rate hike, but no hike and no cut either. So we'll keep going out, stays the same. Go out again, still the same in May. And again, still the same in June of next year. And still the same in July. Still the same in September. Okay. And so basically the CME Group believes that the highest likelihood of a first cut isn't going to happen until November of next year. Our thesis is that's not going to be the case at all. That is the expectation. We don't think that that's going to be the reality. We're going to get into that in a minute. So, here's another cool website I wanted to bring to you guys that you can look at in your own time if you want to. It's called trueflation.com. This is basically on chain data. I'm not sure if this is like a cryptocurrency blockchain version of inflation, but it literally is updated daily. So, as you guys can see, the inflation rate according to this is 2.68%, even though the government reports 3.7. You guys can just scroll through here. It'll show you all the different, basically the different sectors of the market. As you guys can see, a lot of these sectors have been getting reduced or coming down, which is a good sign because then that means the Fed can stop raising rates and causing fear in the markets, right? So there's a lot of metrics here. I'll leave this for you guys, but we're going to get to the important stuff now, okay? So what you guys want to know as investors is if the Fed pauses and or cuts rates, is it going to affect my portfolio as a dividend investor, as a crypto investor, as a swing trader, or as a day trader? Okay. This doesn't apply so much to swing trading and day trading because technically speaking, especially if you're in futures, you can make money shorting or longing. It doesn't really matter what market conditions are as long as the setup's there. So this is more so for investors in crypto, but what I'm going to be showing you guys today is the monthly chart on the effective federal funds rate, or basically the rates that the Fed's using to basically cool inflation. And on the left, we have the SPX, which is the gold standard of investing in the United States. So we're going to go back to 2000 during the dot-com bust, and we're going to take a look at basically how the markets reacted to what exactly the Fed funds rates was doing to investments. Okay. So as you guys can see here, the markets were going up as the Fed was raising rates. And as soon as they paused, the market started selling off, and they basically sold off all the way through the cuts. Okay. And keep in mind, this was not a small drop by any means. This was a big drop. This was about 49%. I know it looks small in the charts, but trust me, it's not small. If you have this thing zoomed in, you're going to be like, holy cow, dude, we're in for a wild ride. So we're going to go over here to 2008. You can see the indicators too on the MACD. It's pretty obvious when they're topped out and when they bottomed out on the RSI and the MACD. But again, I actually have to move the SPX over a little bit to really see this. So basically the Fed was raising rates during 2005, 6, and 7. The markets were going up the whole time. And pretty much not exactly when the Fed hiked, but shortly after the Fed started, or not hiked, halted rates, shortly after the Fed basically had a pause, that's when the markets really fell off a cliff, okay? And we can see from the top to the bottom, again, it was another huge drop, about 55%. It doesn't really look that big here because, we're on the monthly, but if you look at the weekly, it's a whole different picture. So we're going to scroll over one more time, or two more times, to basically we'll call it the zombie virus. I can't say it on YouTube because, YouTube may not like that so much. But basically the black swan event of 2020, you can see that the Fed was raising rates from 2016 pretty much all the way up to 2019. And they paused and the markets just kept going up. And as soon as they cut, funny enough, even though it was a black swan event, the markets fell off a cliff. And we actually 4x'd our money in our retirement accounts during this. We DCA'd on the way down, so it was a pretty crazy thing. We didn't know when it was going to bottom, so we just basically did like small bulk buys on the way down. Like every 300 to 500 points or something like that, we were buying the dip. So again, we're not really going to count this one because it's a black swan event, but you can see it's very similar. So the Fed's been raising rates for quite some time now, but notice on this time around, it actually looks much different. So the markets basically started tanking before the Fed raised rates, okay? And and the market basically tanked pretty much almost all the way to the end of the rate hikes. You can see it stopped tanking pretty much in about November, and the Fed's more or less halted rates a couple of months ago. They had like what's called a skip hike, where they paused for a month or a meeting, and then they hiked 25 basis points for meetings. So it's like 12.5 every meeting. Now they're having a pause. And you guys can see the markets are going back up, but this time it went up much later into the Fed rate hikes. So I'm going to tell you guys what my thesis is going to be on the markets. Do I think the markets are going to fall off a cliff into the Fed pausing and or cutting rates? No, I do not. Here's why I say that. In every other time in the last 25 years that the Fed has hiked rates, we've never seen the markets dump like this. Okay. You can see the clear indication here. If we take a look at the zombie virus, you can see there's a difference here. As soon as they started cutting, you get a dump. As soon as they started raising, you get a dump. We'll go back again one more time just to illustrate the point here. The Fed's raising rates, market goes up. Fed's cutting rates, markets go down. Okay. So we'll go back here. As you guys can see, it did not happen this time. Okay, we basically did the opposite. So what am I expecting going forward? Well, what I think is that the markets have pretty much already priced in the recessionary piece of the Fed's rate hike. And the actual technical bear market that we saw already took place last year. It's over with. And regardless of whether the Fed is pausing rates or they're cutting rates, it doesn't matter. What we expect is that the markets are going to go flat sideways, kind of chop around maybe between 4,200 to 4,600 for maybe the next 6 to 9 months. And then at some point, even with the pause and or cut, the markets will go sideways and then up and basically into new all-time highs. Why? Because based on this price action here, as you guys can see, the market's dumping while the Fed's raising. That's not supposed to happen historically. That's not what happened. The historical data says that when the Fed cuts rates, that's when the market tanks. We have not seen that. So the other thing that I wanted to point out was the unemployment rate. As you guys can see here, these are the inflation data. The inflation data is coming down. What we expect for inflation is that we think that inflation will be between 2 to 3%, probably by, I would say realistically, probably somewhere between January to March of next year. Okay. That's still 3 to 6 months away. There's still plenty of CPI releases to be seen. There's 3 more this year. You can see that they basically have, well, more or less they have like 11 or 12 of these a year. So you're getting at least 4 or 5 more of these. And you'll have plenty of FOMC meetings. So we suspect that basically somewhere between July, maybe as late as April of next year, that both core and headline inflation will be pretty close to 2%, probably at a range somewhere between 2 to 3%. Now for unemployment, as I told you guys in the previous video on the previous FOMC meeting, if these bands cross over, we're expecting bad things to happen in the employment market. We expect unemployment to go up. But the Fed did project that they are not expecting unemployment to go up significantly next year. We're going to keep a close eye on this and let you guys know what we think. But we personally don't think that the unemployment rate is going to go up that much. There's multiple reasons for that. You got a lot of illegal immigrants coming in from all over the world into the U.S. And what happens with that is, you got all these extra people that we normally don't have working jobs and buying stuff and selling stuff. And that, creates a very strong demand in the economy in terms of buying, selling, working, all that stuff. On top of that, you still have the $10 trillion that the government printed from back in 2020, which is still circulating through the economy. There's that. The Fed's still trying to roll out their balance sheet. So we don't think it's going to play out as bad as, say, a 2008 scenario. But again, we'll keep an eye on this, let you guys know what we think. So let me take a drink real quick. We're going to get into the last piece here. So, what does the futures market say about what's going to happen next? Well, you guys can see the settlement prices here. So, I have one pulled up for the S&P 500 and one pulled up for oil. We're actually going to start with oil first. So, oil is currently pushing back to all-time highs. What we want to see on the charts is oil basically sit somewhere between $60 to $80 a barrel and not move. Okay, we don't want to see it to go back above those prices. We want to see it go down there, consolidate, and stay in that area. That would indicate that, oil energy is going to come down. But the futures markets are projecting that this is basically pretty much the top for oil would be next month, this month, next month. And then as you guys can see going forward, it's pretty much going down. So oil is expected to drop by as much as $12 a barrel, or more than like somewhere around 10 to 15% on the charts from now to the end of next year. And for the S&P futures, as you guys can see here, this is the December expiry month. This is basically what's known as the front month contract in futures. So pretty much what happens is, and again, for futures, we had to roll our contract forward from the September expiration date to December because it's every 3 months. I told you guys before, it's bad news. If you trade an expired contract in futures, just don't do it. Okay. Trust me on this one. So basically, since we rolled the contract forward, the price action is going to show up for the December contract during the 3 months before the expiration date. So this price action right here is actually going to show up for September, October, and November, and then so on through these. So basically the first quarter of the year, you're going to get that the markets are going to move up slightly. Okay. That's usually not what happens when the Fed cuts rates. It usually dumps. And then during the second quarter, the markets are going to be back at 4,600 to 4,612 more or less. September, 4,650. December, which would be basically Q4 of next year. So September to November timeframe, 4,667. And if you guys keep looking over here to the right, you can see the settle prices here. It just keeps going up. 46.92, 47.25, 47.49, all the way back to all-time highs. Okay. So anyways, this is the FOMC meeting that was released today. Hope you all enjoyed this content. Please like, comment, and subscribe. We'll see y'all later. Peace.